The silence was the signal. The market didn't drift lower. It didn't roll over on shifting sentiment. It broke, cleanly and precisely, at a moment when the fewest eyes were watching. What you just witnessed wasn't a change of heart. It was a change of rules. A margin adjustment hit the futures complex at the open, and the reaction was not confusion. It was a cascade of automatic, unthinking sell orders. This wasn't a debate about value. This was a forced exit, a liquidity purge. The headlines will scream about a crash in silver, about speculators fleeing, about a bubble popping. They will be wrong. They will be dangerously, structurally wrong, because they are describing the symptom and calling it the disease. The disease is leverage. The symptom is price collapse. And the cure, administered by the exchange's risk committee, is always more painful for the holders of contracts than the holders of metal. This matters because you are being shown a magician's trick. You're being told to watch the swirling cape and the flash of light, while the real move happens in the dark, in the plumbing, in the lines of code that recalculate collateral obligations before your broker's alert even hits your inbox. The real reason the price plunged is not that silver became worthless overnight. It is that the system deemed a certain group of participants too leveraged to survive the volatility they themselves were creating. So it removed them. It didn't ask for their opinion. It didn't wait for their transfer. It sold their positions into a void of midday liquidity, and the price is simply the crater left behind. This is not a market event. This is a risk management execution. And when you understand that distinction, you stop listening to the narrative and start watching the mechanics. The trap has already been sprung. The emotional pressure is now building in the accounts that are being liquidated, in the chat rooms filling with panic, in the hurried reassessments of every bullish thesis. That pressure is the fuel for the next move, because a forced seller does not care about price. A forced seller only cares about survival. And when survival is the only bid, the market falls until it finds not a buyer, but a vacuum. Then, and only then, does the real price discovery begin. But by then, the leveraged are gone. They are spectators. They are reading the same headlines you are, wondering how they were so wrong, when in fact they were never given the chance to be right. The system does not wait for fundamentals to play out. The system operates on a clock of its own making, a clock regulated by margin requirements and volatility scans. Your conviction is irrelevant against a margin call. Your research is meaningless against a maintenance requirement increase. You're not trading a metal. You are trading a contract, and the contract has terms. Those terms just changed. The silence before the break was the warning. The break itself is the confirmation. And the aftermath, the chaotic scramble for explanation, is the distraction. Do not follow the distraction. Follow the logic of the mechanism. A market does not lose billions in value in minutes because of newfound wisdom. It loses it because of forced expulsion. Someone, a collective someone, was told to leave. Now, we must understand who and why and what remains when the forced sellers are finally mercifully gone. The urgency is not in catching the falling knife. The urgency is in understanding why the hand that holds the knife was forced to open in the first place. That understanding is the only thing that separates you from the next purge, because this is not the first time. It is a pattern, a rhythm, a recurring stress test applied to the weakest link in the chain, the overleveraged speculator. And each test passes when the selling is complete and the system resets, lighter, cleaner, and ready for the next influx of borrowed conviction. The clock is already ticking on that next influx. The cycle does not end. It reloads. Let's reconstruct the timeline without the noise. The Asian session was quiet. London opened without event. Then, in the pre-market gloom of New York, the notice was posted. Not a news release, not an analyst downgrade, a routine regulatory filing, a memo on margin requirements. To the public, it's bureaucratic wallpaper. To the machine, it's an immediate command. The effective time was the open. There was no phase in, no grace period. At 8 a.m., the new collateral rules were live. Every long position held on leverage was instantly remeasured against a higher benchmark. Think of it not as a tax, but as a sudden increase in the height of the hurdle you must clear to stay in the race. You are mid-sprint, and they raise the bar. For the institution with a treasury desk and a credit line, this is an inconvenience. A quick wire transfer, a reallocation from another pool. For the retail trader, the weekend speculator, the overallocated fund, this is an existential demand. The cash must be posted, often within an hour, or the position is terminated, not sold down, terminated. The broker's algorithm does not call for a discussion. It calculates the deficit, and it begins to sell. It sells at market. It sells into whatever bid exists. It sells without remorse or strategy. It sells until the account is back in compliance. Now, multiply that single algorithm by thousands. Multiply that single account by a swarm of accounts all hitting the same mathematical trigger at the same millisecond. What you get is not a wave of selling. You get a tsunami of identical sell orders hitting a market that, at that precise hour, is staffed by skeletal crews. The major banks are rotating desks. The quants are recalibrating. Liquidity, the presence of ready buyers, is at its daily low. So the first sell order gets filled at a slightly lower price. That lower price triggers the next layer of automated stops. Those stops become market sells. The cascade is now born. It is a chain reaction of pure mechanistic cause and effect. It has nothing to do with silver's role in solar panels or its scarcity in the ground. It has everything to do with the architecture of the futures exchange. This is the hidden timeline. The public sees the candle, a vertical red line. They assign a story. Silver crashes on demand fears. But the causality is backwards. Silver did not crash, and therefore margins were raised. Margins were raised, and therefore silver crashed. The effect preceded the cause in the public narrative. This inversion is the core of the deception. The exchange's stated reason is always risk management. Volatility increased, so we must protect the integrity of the clearinghouse. This is true as far as it goes, but it is incomplete. The unstated consequence is price control. Not control in a conspiratorial sense, but control in a hydraulic sense. You have built pressure in the system, too many leveraged longs. The pressure relief valve is the margin hike. It bleeds off the excess. It forces the weak hands to surrender their contracts, which are then absorbed at a steep discount by those with cash at the ready. The price drops violently, but the metal does not change hands. The paper claims do. This is the essential, silent truth of the futures market. The real asset sits in a vault. The paper derivative trades on a screen. And the link between them is not physics, but faith and rules. The rules just changed, so the faith was shaken. But only for those who believed with borrowed money. The ones who believed with physical cash felt a very different emotion, opportunity. So the narrative of collapse is a story told to and by the leveraged cohort. The physical cohort sees a fire sale. Two realities bifurcated by a single rule change. The timeline proves it. The crash occurred in minutes, not days. Fundamental shifts do not operate on that clock. Supply and demand are glacial forces. Margin calls are lightning. You're watching lightning strike and being told a story about continental drift. The hidden mechanism is not a trading strategy. It is the market's own immune system, and it is programmed to attack leverage as an infection. Visualize the system not as a marketplace of ideas, but as a pressurized pipeline. Price is the pressure reading. Long futures contracts are valves opening, allowing more speculative pressure into the pipe. The exchange, as the plumber, monitors the gauge. When the pressure reading, volatility, rises too fast toward the red line, the plumber doesn't try to reduce the underlying source of the pressure immediately. Instead, he constricts every valve at once. He turns a dial called initial margin. Suddenly, to keep your valve open, you must exert more force, post more cash. If you cannot, your valve is slammed shut. Your position is forcibly closed. Pressure is vented from the system. The price gauge snaps back to a lower, safer reading. The integrity of the pipeline is preserved, but the contents of the pipe, the actual metal, haven't changed. Only the pressure reading has. This is the metaphor. The reality is, in the algorithms, the so-called risk engines. These are not sentient beings. They are sets of cold mathematical conditions. If 10-day volatility crosses X threshold, then recommend a Y% increase in initial margin. This is presented as prudent, automatic, and neutral. And it is. But neutrality in mechanism does not mean neutrality in outcome. The outcome is always a transfer of wealth from the ill-prepared to the prepared, from the marginal player to the core player. The machine's purpose is to protect the clearinghouse from a domino of defaults. Its method is to force the most leveraged participants to default on their own positions first in a controlled burn. You're witnessing a controlled demolition of speculative excess. The wrecking ball is the margin hike. The dynamite is the leverage itself. Now, layer in a second, darker mechanism. The liquidity vacuum. In a normal market, a seller finds a buyer through price discovery. They meet somewhere in the middle. In a forced liquidation event, there are no buyers, only sellers in a vacuum. The sellers are not trying to get a good price. They are trying to cease to exist as sellers. Their orders are market to liquidate. They take any price. This creates a negative feedback loop with stop-loss orders. Stops are meant to be protective, but in a cascade, they become fuel. They are buy orders for panic. They are promises to sell at a certain pain threshold. When that threshold is breached, the stop becomes a market sell order, adding to the cascade. The market, in these moments, becomes a machine eating its own limbs. It is algorithmic, pre-programmed, and utterly predictable in its pattern. The only unpredictable element is the timing of the margin hike that throws the first switch. And that timing is never accidental. It is calculated for maximum systemic safety, which often coincides with minimum market liquidity. A quiet hour, a holiday-shortened week, a session between major data releases. This is when the immune system strikes, when the patient is resting and the defensive reserves are low. The mechanism is hidden because we are taught to see markets as narratives. A story causes a price move. But in the digital age, the mechanism is the narrative. The price move is the story, the margin hike is the plot twist, and the protagonist is not the trader, but the cold, uncaring logic of the clearinghouse that must survive at all costs. Your portfolio is not a factor in that survival. It is collateral damage. Understanding this means you stop asking, why did silver fall? And start asking, why did the margin requirement rise now? The answer is always found in the pressure gauge, not the newsfeed. The pressure had built to a critical level. The longs were too many, too leveraged, too concentrated. The system felt the strain, and so it purged. It did what it was designed to do. You were simply in the path of the purge. The reaction was delayed because the true impact was not in the first sell order, but in the psychological fracturing that followed. Mechanically, the liquidation was instantaneous. Psychologically, the failure of liquidity was a slow-motion realization that spread from the futures pit to the physical dealer, to the media desk, and finally to the public mind. Liquidity did not fail because buyers vanished. It failed because trust in the price mechanism evaporated for a critical minute. When the screen shows a price dropping 5% in 60 seconds, any rational buyer, even one with cash and a desire for metal, pauses. Their thought is not, this is a bargain. Their first thought is, what do they know that I don't? That hesitation is the kill zone. It is the moment the vacuum opens. The algorithms sense the absence of bids and push harder, lower, faster to find any bid at all. They are digging for liquidity in a well that fear has just poisoned. This psychological failure is the displaced reaction. The market didn't just lose bids, it lost the confidence required to place a bid. And this loss of confidence is contagious. It jumps from the futures screen to the ETF market. It jumps to the mining shares. It jumps to related commodities. It creates a halo of panic far larger than the original margin event justified. This is the displacement. A single mechanical rule, change in a derivatives market, triggers a global crisis of confidence in the entire asset class. The reaction is displaced from its cause by layers of abstraction and fear. Why does this matter? Because the recovery, when it comes, will also be displaced. It will not be a simple rebound. It will be a slow, distrustful recalibration. The first buyers back in will be the arbitrageurs, not the believers. They will exploit the gap between the broken paper price and the still standing physical price. They will buy futures and take delivery, or they will sell physical at a high premium while simultaneously buying cheap paper. Their action is not emotional. It is mathematical. They are the repair crew for the broken trust mechanism. They sew the two disconnected markets, paper and physical, back together with threads of risk-free profit. Their activity is invisible to the headline reader, but it is the most important signal in the aftermath. It is the proof that the crash was structural, not fundamental. The delayed psychological reaction also explains the media narrative lag. The first headlines report the collapse. The second wave of analysis invents reasons, profit-taking and technical breakdown, strong dollar. These are justifications crafted after the fact to explain a move that was, at its core, a mathematical reset. They displace the true cause, the margin hike, with plausible-sounding narratives that fit a conventional view of markets. This narrative displacement is perhaps the most dangerous outcome. It teaches the wrong lesson. It tells observers that such crashes are the result of natural market forces, of collective wisdom turning sour. It hides the truth that this was an administrative action with predictable, violent consequences. It makes the system seem like a wild beast when it is, in fact, a meticulously engineered machine with a safety protocol that looks identical to a predator attack. The tension escalates because the next trigger is now unknown. The system is still under pressure. The volatility gauge is still elevated. The risk engines are still humming. The market knows another margin adjustment is possible at any moment. This knowledge itself becomes a suppressant. It keeps buyers on the sidelines. It encourages weak longs to self-liquidate before they are forced out. It creates a lingering state of anxiety that is more damaging than the initial crash. The real sell-off was over in minutes. The psychological sell-off lasts for days. The beneficiaries are never the ones selling in panic. They are always the ones waiting with cash and a calm understanding of the mechanism. When forced liquidation creates a vacuum, the beneficiary is the vacuum itself, or rather, the entity that fills it. In this case, three groups benefit silently while the public narrative screams disaster. First, the short-side speculators who were caught in the rally. A violent engineered flush down allows them to cover their losing positions at lower prices. It provides an exit, or even a profit, where none existed hours before. They did not cause the margin hike, but they are its direct financial beneficiaries. The relief is the mirror image of the long's pain. Second, the physical accumulators. For the industrial user, the sovereign fund, the family office stacking metal, a price crash divorced from physical scarcity is a logistical gift. It allows them to source ounces, or claims on ounces, at a discount to true replacement cost. Their buying is quiet, steady, and hidden in the over-the-counter market. They do not bid on the screen. They call their broker and ask for delivery. This activity leaves no trace on the price candle, but it drains vault inventory. Third, and most crucially, the clearinghouse itself is the ultimate beneficiary. It has successfully transferred risk from its own ledger, the over-leveraged long who might default, onto the market at large. It is now safer, more robust, and insulated. Its survival is guaranteed. Again, who is trapped? The leveraged long is the obvious casualty. But a second subtler group is also trapped. The retail investor who believes the narrative, the one who sees the crash, reads the bubble-popped headlines, and sells their physical holdings or their unleveraged ETF shares into the panic. They are not forced out by a margin call. They are tricked out by a story. They sell at the lows, transferring real value to the accumulators, based on a fiction. This is the true deception. The media narrative, in its desperate scramble for a cause, becomes a weapon that entraps the uninformed. The institutions understand this. Their communications are crafted to amplify the narrative of a healthy correction, of speculative excess being wrung out. These phrases are true on the surface, but are deployed to elicit a specific behavioral response: continued selling from the weak-handed, non-leveraged crowd. The institutional reality is one of calm assessment and strategic accumulation. The public panic is the feedstock for their opportunity. The contrast could not be starker. On one side, chat rooms and social media flooded with fear, loss porn, and declarations that the bull market is dead. On the other, quiet bids for physical metal, increased inquiry for forward contracts, and internal memos discussing attractive entry levels. Two worlds, operating on different sets of information. One is reacting to price, the other is reacting to structure. The deception is not a lie, it is an emphasis. By emphasizing the price crash and ignoring the mechanical cause, the narrative creates an emotional truth that overpowers logical analysis. It makes people feel that something is fundamentally broken when only a single replaceable component, excessive leverage, has been removed. The exposure here is not of a failing market. It is of a gap in understanding. The system is working exactly as designed. It is the public's understanding of the system's design that is flawed, and that flaw is the most valuable piece of information the beneficiary possesses. What breaks next is not the price. The price is already broken. What breaks next is the illusion of a single, unified market. The fault line between the paper futures price and the physical wholesale price will widen into a chasm. This is the inevitable outcome of a mechanical purge. The paper price, beaten down by forced selling, will trade at a discount to the price of actual deliverable metal. This discount is not a stable condition.